Liftoff of Space Shuttle Atlantis on a mission to build, resupply, and to do research on the International Space Station.
Houston now controlling. Atlantis begins its...
Hey guys, good morning. I want to show you this company called Rocket. They just listed on the New York Stock Exchange a couple of weeks ago. And my buddies in Detroit will be so happy that I'm covering one of their local stocks. This company is based in Detroit and it's founded by Dan Gilbert. He's worth about $60 billion now. This is not your typical red flag ex-con CEO trying to con investors. This guy creates value in everything he does. So this is an interesting company that's growing and making money, but they're making money and growing hyperspeed. So this is really unusual, but it's no surprise when you think about what the business is. It's online software, and as we know from Kathy at ARK Invest, it's the software-only type businesses that generate the really high margins of 80 or 90%. That's why companies like Facebook trade for almost $300 a share. They're all software. Now, in this case, you can see they have 20,000 team members, so it's not just 10 guys running a website. So there's a lot behind it. You can see their revenue is $6.4 billion in the first half of the year. Okay, we're going to go through their financials, but they're growing at a hyper speed, which means what does this business look like in a couple years? It's hard to say. It's worth more than it is today, that's for sure. This seems to be the type of company that Berkshire would invest in if they understood how innovation is disrupting some of the other businesses. So if you own banks, you would want to hedge that risk of banks being disintermediated from their customers because of companies like Rocket. So if the financial sector does well, you'll see this company leading the pack. If you're a big investor in banks, you need to hedge your position by owning this type of company because they're going to be eating your lunch. Good hedging vehicle if you don't already have some of this in your portfolio. So let's go in and take a look at their financials and see what it is that they've got going on. Okay, on August 14th, their second quarter, company achieves record origination volume and profitability. So that's what we mean by scaling a business. They're going to host an earnings call on September 2nd. They're a financial technology company. They're not a bank, consisting of personal finance and consumer service brands, including Rocket Mortgage. Preliminary and unaudited results for the second quarter ended June 30th, in line with the estimated ranges provided in the company's amended registration statement filed July 28th on Form S-1. So this is related to the filing of their S-1, which would have been their prospectus to register shares. And so in that form, they would have detailed what they were expecting the business to do. Today's announcement was made in connection with financial disclosures was required to provide to bondholders. The timing of this disclosure was unique to this quarter given the timing of the company's initial public offering. It does not intend to report preliminary results in future quarters. Okay, so they were required to publish a preliminary report. Going forward, they're going to do what every other public company does. You'll wait until earnings to find out what's happening with the business. So second quarter highlights. Their loan origination volume is 40% higher than the first quarter, and it's 126% higher than the second quarter of 2019. So these are huge numbers. Revenue of $5 billion, up from the first quarter by 270% and up almost 500% from last year. Net rate lock volume is $92 billion, an increase of 64%. And 170% net rate lock volume. I'm not sure what that means. I'm not that familiar with it. We'll have to look that one up. Gain on sale margin was 5%, up 3% in the first quarter and up 3%. So that's what that's telling us is that they're getting margin expansion as their volume goes up, which is what happens if the business scales. The business does not always scale, but software it should. Net income of $3.5 billion compared to $100 million in the first quarter and a loss the previous year. Adjusted revenue of $5.3 billion, up 150% from the first quarter. I mean, come on, guys, these are crazy numbers. These are nuts. This is the kind of business you want to be investing in, don't you? The adjusted net income was $2.8 billion. These are huge numbers, right? These are just massive numbers. I'm incredibly proud to share our record-breaking results for the second quarter. It's the power of our platform and our team members' unwavering commitment. Okay, I mean, that's all I need to see about the business. The only downside to this business is they have like 2 billion shares out there, right? But I'm assuming that Dan Gilbert has got most of them locked up. And if he does, he's not going anywhere. He doesn't need the cash. So he'll hold on to the shares. So I'll be curious to see what the float is. Float, shares outstanding. Okay, this is way behind. It's showing only 100 million. It's showing that 3.5% of the float is shorted. That's hard to believe, right? Share percent of outstanding, 0.18%. That makes more sense. So the short positions are going to be tiny in there. There's no way you're shorting a stock like this. I mean, okay, we'll hop over to the ThinkorSwim platform and take a look.
An ultimate journey to shore up the International Space Station
is just off its all-time high. If we look at the chart, you can see it got listed at around 20 bucks on August 6th. We just hit 30 and we've just come back down 3 days. If you get a consolidation, there's usually a few days, and then you usually see the vols drop back down. You can see here the vols came down a little bit, but now they're starting to creep back up. They have earnings in a week. So this stock, when it announced its final numbers, see, here's the thing with Rocket. This is a bit unusual. It's only going to happen for this quarter, and I just mentioned it, right? That they've already given preliminary numbers, so we know what they're going to report. But going forward, they won't do that. They're only doing it because of the requirements around the bonds that they issue. So we actually know what they're going to report. And these are eye-popping numbers, right? We just went through them. So they're growing at hyper speed. Dan Gilbert owns them. This company long-term will be very successful. So now you want to get long this company, but implied volatilities are high. And they're high because a lot of people know that they're a good company and they are buying calls at any price. What I've done down here is I've already shorted a September put, and now I've shorted an October put. All right, so I'm selling puts, and the reason why I'm doing that is because the implied volatilities are high. See, the thing is when implied volatilities are high, you have to come up with strategies that will benefit you in the implied volatility environment that you're in. Okay, so in this case, the implied vols are high. And so what we want to do is pick our spots, and you got to ask yourself, okay, if we want to buy a call, where would we buy a call? If implied volatilities are really high, you almost have to kind of go deep in the money. So if you notice, if you went out to October, if you bought the 20 call, if you look to the put side, you can see how much extrinsic is in there. So you're basically paying $1 in extrinsic. Now the other way to think about this is what kind of call would you buy out of the money that would have $1.20 in extrinsic? And that's not even on here. If you went out to 44 strike in October, you'd still pay $2 in premium. In this case, you could buy a 20 call for $9, and if the stock moves $1.25, you're going to be making money already. Versus if you buy the 44 call for $2, the stock needs to move $15 before you make $1 on expiry. So you see the difference? So when the vols get really high, you have to think about different strategies. Now, the other strategy we could do in here is we could buy a vertical spread, right? We've learned that, especially when the vols, see how the vols are going up as we go further out? See, if the vols are going to rise further out, that means you can sell those for more money. So this 44 call at $2 is 144%. That's really expensive. If you sell that for $1.90, what are we buying? Right? And then, of course, when you do that, you're capping your upside. Likewise, when you sell a put, you're capping your upsides. It's the same thing. So in this instance, when we look at this, we have to think about it like if we do a vertical and we cap our upside, how much money are we going to be capping when we do that? And with earnings coming up in a week's time, we know the stock's going to move higher. So one strategy could be I'll buy a call today, wait for the stock to rally until the day of earnings, and then sell another call before earnings come out. In this case, it's a little bit different because we actually know what the numbers are going to be. Normally, you don't know, so we may not see the same kind of vol rise that we would normally see because we actually know what the earnings are going to be. It's kind of like Costco, the way they report their earnings every month. So when you get to the quarter end, it's usually not a big move because you pretty much know what they're going to do in here. So one example is we could go in here and buy the 30 call for $4.50 and then sell the 44 for $2. The difference there would be you need to make sure your returns are high enough to make it worth your while. So the other way to do that is to leg into it. If we leg into the trade, we could come in here and buy the 30 call at say $4.50 and then wait for a pop. Well, 3 days ago, this traded up to $2.60. Imagine if you could sell that at $2.60 and buy this for $4.60. Then you're down to $2. Or imagine if you can buy this for a little bit lower on a down day Let's look at what this was trading yesterday. So this one was trading below $4 yesterday. So imagine if you could buy this at $4 and then you wait for this thing to hit 260, and that's a difference between, then that's a 44 strike, right? If we sell the 44 call, then the spread is not $10, it's $14. Wow, this is kind of a no-brainer. I kind of like that trade, actually. I kind of like the idea of buying a call here before earnings and then hope that we see it bounce back up and then selling another call against it and have an upside potential of about anywhere from 500% to 1,000%. Now we can go to the Analyze tab. Okay, so this is what that would look like. We would be capped at 44, and our losses would be limited to 270 if we bought it right where it is. Now, let's say we wait, and we get this at $4. I change the price to 4, and then we wait for a rally, and then we try to sell this at 250. Then our risk is 150, and our max gain is 1250. So at 44, so that would be 150 to 1250 is just less than 10x. So the challenge with this is first we're going to go in and try to buy the call at $4, which is where it was trading yesterday. At that point, we'll have a risk of $400. If the stock keeps dropping and we never get a chance to sell the 44 call, then we could lose $400. So that's your risk on one contract. Then we're going to wait for a rally, and then we're going to, when the vols pop on a rally, we're then going to sell the 44 call around 250. That's going to be my strategy there. That's what I'm thinking about in terms of Rocket. And I'm sharing with you what I've done so far in here on this one account. But this will give you an idea of the kind of strategy you can do. Remember, retail investors lose money because they trade too big. Okay, so if you're new to options, you should be doing one lots. Okay, I can't emphasize this enough. It scares me how often new investors to options want to trade so big. You know, if you're not used to option trading, if you've not done it before, you need to crawl before you sprint. You need to get comfortable with your tools. You're going to make mistakes entering orders. You want those mistakes to be tiny. Okay? Look at the spread in this put that I sold short at 690. It's 670 and 7 now. If you made a mistake and bought this at 690 and now you need to sell it, you know, you're going to lose $20 on one contract. $20 in one contract. On 10 contracts, you're going to lose $200. So you've got to stay small and just learn. Learn and make your mistakes when you're crawling. Don't make your mistakes when you're sprinting. All right, so I'm not giving you financial advice. I'm just walking you through what I'm thinking about, okay? I'm your uncle. I'm not your financial advisor, okay? So I'm here to provide you with moral support, okay? Not financial advice. That's why I call my channel Uncle Dan. I'm family to you, okay? If you need financial advice, you go see a professional. So that's what we're seeing in Rocket today. And, you know, thanks to the guys for pointing out this stock to me on the channel, because I was not looking at it. And this is the beauty of having this channel, is that we can, through Mindshare, uncover unique opportunities. I'm excited about this one, which probably means it's going down, because emotionally, we're usually intuitively wrong on our ideas. So we'll see what happens in here. But I find it interesting. You look at this chart, if you have never touched the stock before, is this stock up or down? I'm just talking to the psychology of trading. Everyone who's gotten in here and bought calls, they bought them all on this day between 28 and 30. A lot of people jumped in here. You see, that's the high volume day. Everyone who bought this stock in here, bought calls with the volatility was high, everyone's losing money. And when you ask them about the stock, the question is, why is the stock coming down? So the psychology is interesting. All we've done is come down here and filled the gap from this previous day. But people think the stock is down, not up. So I had not been in the stock. So to me, when I look at this, I'm not saying why is the stock down, I'm saying why is the stock up? It's just interesting, the psychology of how people perceive a picture of a stock based upon whether they own the stock or don't own the stock, and also based upon where they bought the stock. So it's just the psychology of the markets are really quite interesting. That's why, you know, our friend Maury has recommended this book. And the name of the book is Thinking Fast and Slow. You should check out the book. I've got a link down below. It's around the psychology of how people think when they're investing. Very interesting book if you want to try to fine-tune your skills. Very important for both beginners and professionals alike. All right, so that's Rocket. So good luck, guys.
Downrange from the Kennedy Space Center already, traveling 500